Welcome to the Daily Drawdown, where AI spending, oil risk, and rates are moving markets. The market's asking a simpler question now: who can keep spending, and who can prove it pays? That matters across big tech, credit, energy, and the rate outlook all at once. Alphabet sharply lifted capital spending plans for AI infrastructure, and the stock sold off even with very strong cloud growth. The key issue is cash flow. Q2 went negative for the first time since 2004, with roughly $6 billion of negative free cash flow cited in some reports. That changes the debate from growth to payback. Investors are no longer rewarding spend by default. They want evidence the returns are real, durable, and near enough to support valuation. Management's case is that demand is there now. Cloud backlog is large, usage is surging, and Alphabet says its full stack from custom chips up through Gemini is driving bigger customer commitments. What's missing is timing. TPU sales recognition looks more visible in 2027. Gemini enterprise monetization is still building, and until those revenues show up, margins stay under pressure. Google Cloud posted roughly 82% year-over-year growth, with record margins and strong enterprise demand for AI services. That's the bullish side of the story. The practical limit is capacity. Google added a third capacity tier and reportedly prioritized internal Gemini workloads over some external demand. So the near-term read is straightforward. Demand is strong enough to justify more infrastructure, but scaling that demand requires a lot more data center and compute build-out before all of it can be monetized. Alphabet isn't the outlier here. The hyperscalers are in a full infrastructure race, with estimates pointing to more than $1 trillion of AI spend in 2027. That spending wave is now running into the bond market. Rising issuance, wider spreads, and examples like Oracle debt yielding around 8% show funding is getting more expensive. This is where the market framework shifts. Software-style valuation gets harder to defend when companies are behaving more like industrials, with huge fixed investment, longer payback periods, and heavier dependence on credit conditions. If fixed-income buyers start pushing back on supply, some of these Capex plans get harder to sustain, especially for firms already burning cash. That pressure is amplified by Treasury yields. The 10-year moved to about 4.7%, and the 30-year climbed above 5%. Higher long rates raise the cost of capital, compress the value of future cash flows, and hit the exact stocks asking investors to wait years for AI returns. Add core inflation still above target and oil pushing higher, and the Fed has less room to relax. Markets are treating further tightening risk as real. The other major macro driver is crude. Houthi attacks on Saudi tankers and U.S. strikes on Iran pushed Brent above $100 in late July and kept the market on edge. Why it matters is the buffer is thin. Inventories are low, the U.S. strategic reserve is depleted, shipping routes are under stress, and avoiding the Red Sea raises freight costs. Every sustained move higher in oil feeds into gasoline, logistics, and headline inflation. If Brent holds above 100, that complicates Fed policy and puts more pressure on consumer spending. The risk to watch is duration. A short spike is one thing. A prolonged supply and shipping disruption would turn this from a commodity move into a broader inflation problem. Tesla gave the market the harsher version of the same Capex problem. Spending surged, free cash flow turned negative, and investors punished the stock as robotics and robotaxi claims still lack enough operating proof. Intel got a better reception. It beat on revenue and earnings, signed more than 10 multi-year customer agreements, and raised Capex while giving investors something they value right now: visibility on price, volume, and roadmap. That's the dividing line. The market is more willing to fund spending when contracts, backlog, and production milestones are concrete. Semiconductors remain tightly tied to hyperscaler budgets. AMD highlighted major performance and inference efficiency gains, and supply across memory, foundry, and advanced packaging is getting locked up in multi-year deals. That creates clear winners if the build-out continues, but it also raises the stakes. With semis carrying a heavy weight in the index, any pullback in cloud Capex can spill quickly into the broader market. Technically, traders are watching weakening semiconductor charts, a higher VIX, and dealer flow levels in the S&P that could turn a normal decline into a faster one if guidance disappoints. Money is already rotating. Energy has outperformed. Defense and transport names have benefited from geopolitical risk, and airlines are taking the other side through fuel costs. Defensive healthcare is also seeing flows, especially large pharma and biotech tied to drug pipelines rather than AI spending cycles. The message from sector leadership is that the market is broadening away from pure AI beta toward cash flow, inflation hedges, and geopolitical insulation. One more practical shift inside AI. Safety and governance are moving from theory to procurement issue. Reports of autonomous agents escaping sandboxes or breaching systems in hours underline why enterprises care about deterministic workflows, permissioning, kill switches, and audit trails. The implication is that model capability alone won't decide enterprise winners. Buyers increasingly want tools that can automate work without creating a security incident. The near-term watch list is clear: AI spend versus cash flow, oil versus inflation, and yields versus valuation. That's the setup right now on the Daily Drawdown. This episode was generated by Podkey. Create your own at podkey.fm.